And when we try to automate something, it's always, how can we automate what people don't see?
Yeah.
Because to people, it's still extremely important to talk to other people. Because if you're trying to make a form, and that was I guess the old way of digitalization. That you made an internet form and you had people fill it out, and then we would get back like the computer says no type of responses. And I think people are really fed up with that.
Yeah,
it's the same as if customer service goes too far with chatbots and similar things, like customers will just get angry because the company is trying to isolate itself from its customers instead of trying to make all the back office tasks more efficient and trying to actually talk to their customers.
Jørund, thank you so much for coming down. It's great meeting you.
Thanks for inviting me.
Yeah, so let's just get started. Tell us who you are and what you do.
Yeah, so my name is Jørund, obviously, and I'm the managing director of FundingPartner Norway. Mm-hmm. So that means I have responsibility for the Norwegian part of FundingPartner. We're currently in Norway and in Sweden. Mm-hmm. And my main responsibilities as managing director is just making sure everything's working, basically. So taking care of people working with credit and marketing and sales, and also making operations work.
Mm-hmm. Okay, so tell us about FundingPartner. What is its core value proposition and what problem is it solving in the market?
Yeah, so basically what we do is that we connect companies or small, medium-sized businesses that need financing with investors that want to invest in those companies. Mm-hmm. And we do this through a lending model. So we don't do equity or direct investments, rather we structure things as a loan, mm-hmm. So that the companies can borrow money. And the problem we're trying to solve is to actually get more capital to the small and medium-sized enterprises. Yeah. Today, and I guess since 2010, 2011, the funding going from banks to small and medium-sized businesses has remained quite steady, while the funding to everything else has increased. So small and medium-sized businesses are falling behind in terms of getting actual funding. Mm-hmm. And our idea is to create a new market where they can borrow money so that they can grow faster.
Right, and why is it that small and medium enterprises struggle to get access to funding capital?
I think it has a lot to do with the size of these companies. So if you look at the regular, the profitability of a customer, if you're a large customer, you're going to borrow a lot of money. And a larger loan means larger fees, it means more interest and everything. So the manpower used to evaluate the loan is often the same regardless of the size of the loan.
Right.
So therefore, lots of the larger banks and other financial institutions, they focus on large customers because they think it's more profitable. Mm-hmm. So our challenge here is to try to make it profitable and efficient to lend to small and medium-sized enterprises.
Right. Okay. So when I was looking at your website, I saw that you had a number of different projects. Yeah. That range from real estate to other types of projects. So tell me a little bit more about the composition of your customer base. Who are the customers that traditionally come for a loan?
Yeah, very good question, actually. I think mostly, I guess 50 to 60% is real estate, which if you look at the balance sheet of a bank, it's about the same. Mm-hmm. So as real estate is a large portion of the economy, we will have some real estate there, and those are typically housing developments, commercial real estate properties, and so forth. Yeah. And the other focuses that we have is technology companies, which is a niche that very few venture into. Where we give loans to venture-funded companies, mm-hmm. so they can sort of bridge finance between their first and their second fundraising round, for instance, mm-hmm. and also more regular, like old school, medium-sized companies that just they have a profit, they make money, but they want to grow faster, and then they need to borrow either to buy a new company or to hire new employees or similar things. Right.
Okay, and I think we've been seeing a trend in the market in which loan capital that traditionally was the business of banks has been going towards other different alternative sources. Why is this happening?
I think it has a lot to do with technology, and I think also, you know, especially the banking industry is very heavily regulated. Or everything within finance is very heavily regulated, but banks are even more regulated, which means that they have lots of limitations to what they can do. And with the growth of new business models and the growth of new ways of doing things, the financial system hasn't kept track on that. You know, we hasn't been able to adapt as quickly. So what's happening now, I would say, is more a democratization of finance, where you're making what wasn't profitable before profitable now, because you can use new technology to do things more efficiently. So take our business, for instance. I guess if you were to compare us with anything, it would be some sort of investment bank. And an investment bank, they have their spreadsheets, and they have lots of people, high earners, top earners, that sit around and they call customers and they try to make them invest in loans. When we put out a loan, like today we put out 2 loans, they were filled in less than an hour, and we didn't call a single customer because the customers are already on the platform. So what would, you know, cost a company or an investment bank, you know, tens of thousands or hundreds of thousands to actually do, we do in much shorter time without the same manpower that's needed.
And is that because of the technology that you use or the community?
Both, I would say. I think it's tech enabled. So the technology itself, of course, it's difficult to replicate and difficult to make, but that's not a key driver. Like, the technology is enabling the change, and then it's a mindset change and an innovation of processes and how you do things.
Right. Well, that's really fascinating. So the question I have is, if the banks are starting to lose market share when it comes to loans for small and medium enterprise, what's been their competitive reaction? Are they? Is this just revenue they're letting go out the door, or what are they doing about it?
I think actually, I don't think they would see it as they're losing revenue, because these are clients they didn't want to give that much loans to anyways. So for them, it's not a profitable way of. It's not within their business model. So we're sort of a complement. So most banks have been extremely welcoming to us. We even have a bank owning part of our company. The Norway's largest bank, DNB, were one of the first investors in funding partners. So they've been extremely welcoming, and you know, they can give us tips about cases that we should look into. They can send customers to us. So it's been extremely welcoming, and I think the main reason for that is that we're not trying to compete with a bank. If we get a customer, you know, saying, I have this huge portfolio that I want to refinance and I want the lowest interest, we're saying, you know, that's not our business. It's not, we can't be competitive there. But if someone comes to us and they say, I have this project I need to do, and it's a bit too risky for the banks to actually look at, then we're okay, we can maybe make something happen here. So we're not in the same spaces, basically.
That's really interesting. Now, tell me a little bit about the other side of the equation, which is the investors. So we're also seeing that, as you're saying, with the democratization of financial services, specifically of wealth management, that there's the new type of investors coming into the market wanting to put some money behind projects. So why do you think this is happening to begin with?
I think investors always, they seek good returns, and I guess from our perspective, we're a new type of asset class, and if you look at crowd lending in other countries where you have data points such as Great Britain and other European countries, you can see that it has consistently outperformed most of the bond markets. So for an investor, investing in this type of financing is sort of, when you're investing in debt in the first place, or fixed income, this is one of the most attractive things to actually invest in it, and it has proven to give the best returns. So for them, I think it's a matter of, you know, they want good returns, and also it's access to a product that they couldn't get anywhere else. If you're a regular investor and you want to invest in a corporate bond or something like that, like the minimum amount you need to invest is 100,000 euros typically. We have, you know, 100 euros as our minimum amount. So it's a lot easier, and it's a lot more accessible to actually start investing and building a portfolio. because obviously you can't just invest in one loan, you need to invest in a large portfolio for it to actually.
Right, so I guess the seasoned investor would just see your product as a new asset class.
Yeah.
But what about, I'm pretty sure that perhaps the fact that you have such a low threshold brings in people that perhaps have never invested before.
Yeah, actually we try not to get that many of those.
Okay, tell me about that.
Yeah, no, and it might be contrary to what a lot of other places do, but for us, it's a new product, and we're always extremely concerned with trying to get the type of investor that understands the product. So that's been very important to us in the way we market ourselves, in the target groups we go after. We try to find highly educated people that have done investing before. We know that we're not going to be the only asset in their portfolio. We're just a part of their portfolio.
Right.
But we think we're a good addition to their portfolio. So we would actually, if someone came to us as a new investor and said, I've never done any investing in my life and I'm trying out your product, we would say, yeah, maybe you should buy a
mutual fund.
Yeah, mutual fund or something like that. Go to somewhere else.
Right. Okay, that's interesting and surprising at the same time. Yeah. So tell me, how does Funding Partner goes about assessing the risk? The profile of the different projects that you have on your platform?
Good question. That's without doubt the most important thing that we do, because we're built on trust, obviously. So if we, and on our webpage you can see all our statistics, you can see all our returns, you can see how much interest has been paid, how many defaults have there been, how much losses have there been. So we're extremely open about this, because it's all about getting trust and having people's trust.
Yeah.
Then obviously assessing the credit of the company is extremely important. So I'd say out of a team in Norway, we're about 20 people, and I'd say 15, between 13 to 15 of them work directly with assessing companies.
Okay.
And we work, I'd say we have lots of the same frameworks as banks, but we're a lot more nimble in the way we treat them. So we use obviously lots of new tools to give us like a full view of the companies we evaluate. We look into the backgrounds of the people that are involved in these companies to see, do they have like a bankruptcy history, have other creditors lost money on them before, are these good people or not, basically. And then we evaluate the project, we evaluate the company itself, and then we make a final assessment of the company and say, and we put that up for a committee and say, do we want to do this or not? And to try to make this more efficient, we've also been developing a new credit model where we teamed up with something called Norsk Regnesentral, which is like the main math house, I'd say, in Norway. They built the credit models of most banks, and they built, the COVID forecast models for the national health authorities. So really clever people teamed up with our data scientists. Have created a new model where we take in a lot of different factors and then make an assessment of how likely is this company to default or not.
Right. That's really interesting. Just a minute ago, you mentioned that thanks to technology, you're able to basically bring the projects to market with basically no overhead, right? Where else in your value chain are you leveraging the power of technology to find efficiencies? Yeah,
so I think we leverage it everywhere. So in terms of funding the loan, filling the loan, that's obviously what I mentioned, where we leveraged it a lot. In terms of handling the loans, handling payments, handling everything there, we're trying to make that as automatic, as efficient as possible. And then obviously the credit assessment itself is it's a place where we have to be extremely careful, but we're also working to make that more efficient. So we're always going to have some sort of human touch to it, because I believe that our analysts, they speak with the borrower, they understand the business, all that. It's very difficult to evaluate the business without having spoken to the people that are applying for a loan, especially if it's a big loan.
Yeah.
But we can still do a lot of things to enable them to be more efficient, and that's, you know, what type of dashboards are they working in? Do they have to gather all the information from the company and then set it up in a spreadsheet themselves, or can they just write in the company name and they will have a pre-made, you know, report showing all the key figures, showing the cash flow, showing everything about the company that you need to know for a credit evaluation.
Yes.
So that's one example of how we're trying to make things more efficient. So basically enabling people to do less of the, you know, the jobs that consume a lot of time, basically. We're trying to cut down on that and cutting back on all back office tasks, basically, and then having more front office time, more customer facing time. That's the most important thing.
Right. Okay. Tell us about what, if I were to go and speak to one of your customers, whether it's an investor or a company that's gotten a loan, what would they say about FundingPartner?
Good question. I think if you go to a borrower, to start with that side of the platform, I think they would say, you know, we're very efficient and we're a lot more flexible. We have a can-do attitude instead of saying, you know, if you go to a lot of other places, they're going to say like, no, we can't do it, and then they try to convince them. But we're like, okay, this is new, but let's try to figure out how we can do it, instead of saying, you know, no, we can't do this, and then they have to argue. So they will feel a lot less friction, basically, and flexibility. If you look at the investors, I'd say they would characterize us as extremely thorough and very open. Like if we put out a loan and the company that's applying for money has a payment remark, we're going to write about that payment remark. If the person owning the company has a bankruptcy history, we're going to write about that. So people can, you know, see the evaluation and see all the facts about the company and trust that they get as much information that's relevant as possible, so that they feel that you know, no one's trying to fool them. So that's extremely important, and I think also a lot of people would be surprised that we're so personal and really engaged with all our customers. So personally, I speak to lots of investors and lots of borrowers every single week. My phone number is you know, open on the webpage. I send a welcome email to all investors that register, and, you know, say, here's my personal number. Please call me anytime. And even though we have 13,000 investors, that's still working quite well. So I think they also feel that we really care about the product, and we are very open to feedback and to improving it. Yeah.
Well, that's revolutionary, right? Because you don't really ever get that kind of relationship, I guess, not with traditional banks, unless you have an account manager or something like that.
Yeah, exactly. You know, we try to turn that around, as I said, you know, with trying to make all the back office tasks more automated, and then we have to spend our time doing something, and we could just as well be facing our customers then and talking to them.
But I think that's a really interesting perspective, right? Because we keep hearing that digitalization is going to get rid of jobs, etc. But in reality, it's actually helping change the formula that traditionally has served the market by automating back-end functions and giving more time for people to actually develop those closer relationships with customers, right?
Exactly, that's the way we see it, and when we try to automate something, it's always, you know, how can we automate what people don't see? Because to people it's still extremely important to talk to other people, because if you're trying to make a form, you know, and that was I guess the old way of digitalization, that you know, you made an internet form and you had people fill it out, and then it would get back like the computer says no type of responses, and I think people are really fed up with that. It's the same as you know, if customer service goes too far with chatbots and similar things, like customers will just get angry because the company is trying to isolate itself from its customers instead of you know, trying to make all the back office tasks more efficient and trying to actually talk to their customers.
Wow, that really is a departure from the traditional digitalization journeys that we've heard from most organizations. That's really interesting. Okay, let's be a bit creative now. And what do you think the lending space would look like in 2030?
2030, I think it will be way more decentralized than it is now. I think you'd have more companies specializing in different things. So, for instance, what you're seeing with the new banking infrastructure that's growing and that's coming right now. We can see, you have basically a huge common back office, and then you have small banks running on the same back office or running on the same programs, or even running on the same balance sheet. But they have different marketing windows or different storefronts, as to say. I think we'll see more of that, and also I think we'll see within our space, crowd lending and that type of lending space. I think you'll see a lot more growth. We're seeing the Norwegian market, at least, and the Swedish and the Scandinavian market is growing quite rapidly. And I think that will just increase because it's the type of capital that if you look at large companies, for instance, the high yield bond market, to use a very boring example, but like the high yield bond market has grown a lot for the past decade or so. And like the high yield bond market for small companies, basically, crowd lending hasn't grown, or it's grown, but it's super small compared. So I think when you're actually able to digitize more and you're able to do things more efficiently, more companies will open their eyes to this, and it will be a much more common way to do financing.
Right, and then just to close, what can we expect to see from FundingPartner in the next 2 to 3 years?
We're gonna keep growing, basically. So we've been growing at 100% a year, and I hope we can keep that growth rate. We just expanded into Sweden, so we're still gonna keep pushing that and growing even further there. It's a difficult answer to get too technical about, because it's 3 years ahead in time. But I think growth is basically what we're aiming for. At the same time as keep making sure that the growth is sustainable, and we're lending out to our investors are lending out to the correct companies.
Well, Jørund, I have to say thank you so much for coming down and chatting to us. I love hearing examples like FundingPartner, where you're completely challenging a status quo that's been just the norm in the industry, and that you're doing it so successfully. So thanks for sharing that with us.
Thank you so much for the invite, Chris.
Yeah, thanks.